After a torrid 2022, bond markets delivered welcome gains to investors in the first quarter of 2023. During January, bond markets powered ahead as falling inflation stoked optimism that peaks in interest rates would be lower than previously thought and that an economic soft landing could be achieved. However, a blockbuster US jobs report in February, coupled with stronger than expected economic data and fresh warnings from central banks that the battle against inflation had not yet been won, reversed all of January's gains and more. Bond markets rallied once again, though, in March as the failure of several banks rekindled fears of recession due to tighter credit conditions. This revived hopes that central banks would be cutting interest rates before the end of the year. The UK government gilt market finished the quarter with a gain of just over 2%. Mirroring the performance of bonds, and for the same reason, stock markets got off to a barnstorming start to the year, with global stock market indices rising strongly in January. In February, rising bond yields presented a headwind for stock markets, which then fell sharply at the beginning of March as the failure of Silicon Valley Bank and rescue of Credit Suisse evoked memories of 2008, prompting a wave of risk aversion amongst investors. With its heavy weighting in banks, the UK stock market was impacted more than others. However, swift action by the authorities and the absence of contagion meant that investor confidence was quickly restored. And over the quarter as a whole, global equities were up by more than 7% in local currency terms, and UK equities by just over 3%. The balancing act being performed by central banks between taming inflation and avoiding recession got even harder in March as a new fault line emerged in the banking sector. The crises at Silicon Valley Bank and Credit Suisse were largely self-inflicted and reflected specific issues at those two firms. The banking system as a whole is substantially more robust than it was before 2008's financial crisis, and this is unlikely to lead to any sort of sector-wide crisis. Thanks to a mild winter and tumbling gas prices, easing of goods shortages and more favourable year-on-year price comparison effects, we expect headline rates of inflation to continue to decline. Despite February's unexpected blip, Prime Minister Sunak's pledge to halve the inflation rate by the end of this year is still very achievable. Core inflation, though, which excludes energy and food, is proving much stickier. In the US, the headline inflation rate has dropped from a peak of more than 9% in June last year to 6%, but core inflation has fallen only about 0.5% to 5.5%. But why is this? Well, in no small part because labour markets, consumer spending and economic growth have so far remained surprisingly resilient, even as interest rates have soared from near zero to more than 4% in the UK and to 5% in the US in little more than a year. Unemployment rates continue to be close to 50-year lows, both here and in the US. Wage growth, though, after inflation is currently still negative, and this is prolonging the cost of living squeeze. The outlook for bond markets looks finely balanced. If the recent problems in the banking sector are a cause or sign of economic troubles ahead, then bond prices could rally. If, however, the financial school blows over and the narrative returns to the fight against inflation, then bond yields might be too low and prices vulnerable to a setback. At the back of our minds, we also continue to be troubled by spiralling levels of government indebtedness. We therefore remain underweight in gilts and have more money in short-dated bonds overall, reflecting our generally cautious view. Compared to a year ago, though, investors in bonds are now at least being paid a reasonable rate of return just to own them. Although the immediate danger to financial stability seems to have been contained, we expect volatility to be an ongoing feature of stock markets. Although share valuations are generally much lower than they were, they are still not compellingly cheap. The outlook for corporate profits also remains uncertain, and we expect good stock selection to be important this year and those companies with dominant market positions and pricing power look best placed to weather any forthcoming economic downturn.